You know what drives me absolutely crazy? Watching people throw money at the stock market like they're feeding coins into a slot machine, completely ignoring the fact that they've got credit card debt charging them 22% interest sitting right there, laughing at them. It's like trying to fill a bucket that has massive holes in the bottom and wondering why you're never making any progress. You pour water in, but it just drains out. You feel like you're doing something productive. Look at me, I'm investing. But the bucket never gets fuller. Hi, I'm Hamster. And if you've ever wondered why you're working hard, saving money, maybe even investing, but somehow never seem to get ahead, this video is for you. I've spent years obsessing over optimal investment strategies, behavioral finance, and why otherwise intelligent people seem determined to do everything in the wrong order when it comes to building wealth. And what I've found is this: it's not about how much you make, it's not even about how much you save. It's about the sequence, the order of operations, the hierarchy of where your money should go first, second, and dead last. Most people skip straight to the fun stuff, picking stocks, chasing crypto, buying the latest meme ETF without doing the boring foundational work that actually matters. And then they wonder why they're not getting anywhere. If you're someone who actually wants to understand the proper sequence for investing your money instead of just throwing dollars at whatever sounds exciting, hit subscribe. Give this video a thumbs up, especially if it ends up saving you from some expensive mistakes, because I promise you some of this is going to surprise you. Here's something that might genuinely shock you. According to recent data, 1 in 3 Americans doesn't have an emergency fund at all. Zero. Nothing. And the median amount that Americans have saved for emergencies? A whopping $500. $500, that's less than most people's monthly car payment. And here's the kicker, it's actually down from $600 just a year ago. People are going backward. Meanwhile, these same people are asking me whether they should buy individual stocks or invest in cryptocurrency. They're asking about options trading, about the next hot IPO, about whether they should put money into NFTs. It's like asking whether you should buy a Ferrari when you don't even have enough money to fix the transmission in your current car. You're trying to sprint before you can walk. You're picking out curtains for a house that doesn't have a foundation. This is the problem. There's an optimal order for investing your money that can literally save you tens of thousands of dollars over your lifetime and dramatically accelerate your path to financial independence. But most people completely ignore this sequence because it's not as exciting as picking the next hot stock or trying to time the market. They want to skip straight to the fun stuff without doing the boring foundational work that actually matters. Today, I'm going to walk you through the exact order you should be investing your money step by step so you can maximize your returns while minimizing your risk. And I guarantee some of this is going to surprise you, especially the part about why your employer match should come before almost everything else and why health savings accounts might be the most powerful investment vehicle most people are completely ignoring. Before we dive into the specific steps, let me tell you why getting this order wrong can be so devastating. Because this isn't just about being less efficient. This is about actively sabotaging your own wealth. Imagine you're building a house. Would you start by picking out fancy light fixtures and granite countertops if your foundation was cracked and your roof was leaking? Of course not. That would be insane. You'd fix the foundation first, you'd fix the roof. Then, and only then, would you worry about making it pretty. Yet, that's exactly what most people do with their finances. They get excited about investing in the latest trendy ETF while carrying high interest debt that's guaranteed to destroy any gains they might make. They're picking out granite countertops while the foundation is crumbling beneath them. The opportunity cost of getting this wrong is massive. Let me give you some numbers to make it real. Every month you delay paying off credit card debt that's charging you 22% interest is a month where that debt is growing faster than almost any investment you could reasonably expect to make. The S&P 500 historically returns about 7 to 10% on average. Your credit card is costing you 22%. That means your debt is growing more than twice as fast as your investments are likely to grow. You're losing the race before you even start. Every month you ignore your employer's matching contribution is literally free money you're leaving on the table. Money that your employer is trying to give you and you're saying, "No thanks, I'm good." It's like walking past a $100 bill on the sidewalk because you're too busy looking at the sky. And every month you contribute to a taxable investment account before maxing out your tax-advantaged options as money you're unnecessarily handing over to the IRS. Money that could have been growing tax-free for decades but instead gets nibbled away year after year. The good news? Fixing this is simple. Not always easy, but simple. You just need to follow the hierarchy. And that's exactly what we're going to do now. Before you invest a single dollar anywhere, before you buy a single stock, before you put money in an IRA, before you even think about cryptocurrency, you need to establish an emergency fund. I know. This sounds boring. I know you'd rather hear about which stocks are going to make you rich. I know you want the exciting stuff, but here's why this matters more than you think. An emergency fund isn't just about having money for unexpected expenses, though that's certainly important. It's about creating a psychological safety net that prevents you from making terrible financial decisions when life inevitably throws you a curveball. When your car breaks down, and it will, having an emergency fund means you don't have to sell your investments at the worst possible time. It means you don't have to rack up high-interest debt to cover the expense. It means you can fix the problem and move on with your life without derailing your entire financial plan. Let me ask you something. When the stock market crashes, and it will, what are you going to do if you need money? If you don't have an emergency fund, you'll be forced to sell your investments when they're down. You'll lock in those losses. You'll turn a temporary dip into permanent damage. That's not investing. That's gambling with your survival money. The question everyone asks is, how much should you save for emergencies? The traditional advice is 3 to 6 months of living expenses, but honestly, that range is so broad it's almost useless. The amount you need depends on several factors. If you have a stable government job with great benefits, you might be fine with 3 months of expenses. If you're a freelancer in a volatile industry with no safety net, you might need closer to 6 months or even more. If you have kids, a mortgage, a car payment, you probably need more. If you're single, rent, and take public transportation, maybe less. Here's what I recommend for most people. Break it into milestones. Milestone 1. Save your first $1,000 as quickly as possible. This covers most minor emergencies, a flat tire, a broken appliance, a sudden dental bill. It gives you that psychological safety net and prevents you from reaching for the credit card. Milestone 2. Work toward 1 month of living expenses. You've got a cushion now. You can breathe. Milestone 3. Keep building until you reach 3 months of expenses. This is your target. At this point, you're protected against most realistic emergencies. This approach breaks down what can feel like an overwhelming goal into manageable chunks. You're not trying to save $15,000 overnight. You're trying to save $1,000 this month, then another $1,000 next month, bite-sized pieces. Here's something interesting that most people don't realize. Recent research from Vanguard found that people with at least $2,000 in emergency savings had financial well-being scores that were 21% higher than those without any emergency fund. That was the largest boost linked to any financial factor they measured. Not income, not investments, emergency savings. $2,000 isn't life-changing money, but the psychological impact of having that buffer is enormous. It changes how you think. It changes how you sleep. It changes the decisions you make. Once you've got your emergency fund in place, the next step is absolutely critical. You need to eliminate all high-interest debt before you invest in anything else. And when I say high-interest debt, I'm talking about anything charging you more than about 8% annually. Though the threshold can vary depending on current market conditions. But if it's above 8 to 10%, it's a priority. Credit card debt is the obvious villain here. With average interest rates over 22%, credit card debt is financial cancer. It grows faster than almost any reasonable investment return you could expect, which means carrying credit card debt while investing is like trying to run a marathon with a backpack full of rocks. Mathematically, paying off debt with a guaranteed high interest rate provides a guaranteed return equal to that interest rate. If you pay off a credit card at 22%, you are essentially earning a guaranteed 22% return on that money. No stock, no bond, no crypto investment can promise you that. Let me put this in perspective. If you have $5,000 in credit card debt at 22% interest and you make only minimum payments, you'll pay nearly $2,800 in interest over 5 years. That's $2,800 that could have been working for you instead of against you. Every dollar you use to pay down that debt is essentially earning you a guaranteed 22% return. That's better than Warren Buffett's long-term average. Let that sink in. You can beat Warren Buffett by paying off your credit card. The strategy: debt avalanche versus debt snowball. The strategy for paying off debt efficiently is straightforward, but there's a decision to make. Method 1. The avalanche. List all your debts with their interest rates. Pay the minimums on everything. Then throw every extra dollar at the debt with the highest interest rate. Once that's gone, move to the next highest. Pro: this saves you the most money mathematically. It's the most efficient. Con: if the highest interest debt is also the largest, it might take a long time to pay off. Some people lose motivation. Method 2. The snowball. List all your debts by balance, smallest to largest. Pay the minimums on everything. Then throw every extra dollar at the smallest debt. Once it's gone, roll that payment into the next smallest. Pro: you get quick wins. Paying off a small debt feels great and keeps you motivated. This is about psychology, not pure math. Con: you might pay a little more in interest over time. I'm in the snowball camp for most people. Personal finance is 80% behavior and 20% math. If the avalanche method works for you, great. But if you're someone who needs to see progress to stay motivated, the snowball method is your friend. The key is to pick one and stick with it until all your high interest debt is gone. Here's where it gets interesting. There's one major exception to the rule about paying off debt before investing. And it's so important that it actually becomes the next step in our optimal investment order. If your employer offers matching contributions to your retirement plan, you should contribute enough to get the full match, even before you finish paying off high interest debt. I know, I just told you to kill debt first, but hear me out, the math is compelling. Employer matching is essentially a guaranteed 100% return on your investment up to the match limit. Sometimes it's 50%, sometimes it's 100%, but either way, it's a massive guaranteed return. Even if you're carrying credit card debt at 22%, getting a 100% immediate return usually makes sense. It's like finding money lying on the ground that your employer will double if you pick it up. Let me give you a typical example. Your employer might match 50 cents on the dollar up to 6% of your salary. If you earn $50,000 annually, contributing $3,000 to get the full $1,500 match represents a 50% immediate return, plus whatever your investments earn over time. No other investment opportunity can guarantee that kind of return. The key is to contribute just enough to get the full match. Then redirect all your extra money back to paying off high-interest debt. Once the debt is gone, you can increase your retirement contributions. This strategy maximizes your guaranteed returns while minimizing the time you're paying high interest rates. There's one important caveat, though. Some companies have vesting schedules that determine how long you need to stay with the company to keep the matching funds. If you don't plan to stay at your current job for very long, make sure you understand the vesting schedule. Some companies vest immediately, others take 2, 3, even 5 years. However, even with vesting requirements, the immediate return from employer matching usually makes it worthwhile. Just know what you're signing up for. Once you've got those foundational pieces locked down, emergency fund, high interest debt eliminated or under control, and employer match captured, we move into what I call the tax optimization zone. And this is where things get really interesting. Most people completely mess this up because they get distracted by shiny objects and skip right to taxable investment accounts when they should be maximizing every tax-advantaged option available to them first. Step 4. The individual retirement account, IRA. Now we get to maximizing your IRA. And here's why this comes before putting more money into your employer's 401k. Your IRA gives you far more control over your investment choices and typically comes with much lower fees than most employer plans. Corporate? 4. 401k plans are notorious for offering a limited menu of expensive mutual funds with management fees that can eat into your returns like termites in a wooden house. With an IRA, you can invest in low-cost index funds and ETFs that charge fees of just a few basis points instead of the 1 to 2% fees common in many 401k plans. That might not sound like much, but over decades, those fee differences can cost you tens of thousands of dollars. It's the difference between keeping your money and slowly feeding it to fund managers who drive nicer cars than you do. For 2025, you can contribute up to $7,000 to an IRA, or $8,000 if you're 50 or older. The catch-up contribution is like a participation trophy for getting old, except this one actually helps you retire comfortably. The traditional versus Roth decision. Once you've maxed out your IRA contributions, then you can go back to your employer's 401k and start contributing beyond the match. But here's where the decision gets more complex, and it's something that keeps financial advisors employed and ordinary people confused. You need to choose between traditional and Roth versions of these accounts, and the choice can literally save or cost you thousands in taxes over your lifetime. The decision boils down to a simple question that has a complicated answer. Do you want to pay taxes now or later? Traditional accounts let you deduct contributions from your current taxable income, but you pay taxes when you withdraw the money in retirement. You get a break now, but the government gets its cut later. Roth accounts make you pay taxes up front, but then all your withdrawals in retirement are completely tax-free. You pay the tax now, and then the government never touches that money again. Here's the general rule that works for most people. If you're currently in a high tax bracket and expect to be in a lower one in retirement, choose traditional. Take the deduction now. If you're in a lower tax bracket now but expect to be in a higher one later, choose Roth. Pay the lower rate today. The problem is that predicting future tax rates is about as reliable as predicting the weather 3 months from now. Young people starting their careers should probably lean toward Roth accounts because they're likely in their lowest earning years, and tax brackets will probably only go up from here. High earners who are hitting their peak income years might benefit more from traditional accounts to reduce their current tax burden. But honestly, if you're not sure, splitting your contributions between both types creates tax diversification and gives you options in retirement. You don't have to pick one, you can do both. If you happen to have access to a health savings account, HSA, this is where things get really exciting. Because HSAs might be the most underutilized investment vehicle in America. They're like the Swiss Army knife of tax-advantaged accounts. An HSA offers not one, not two, but 3 different tax benefits that make them absolutely incredible for the right people. Tax deduction on contributions, just like a traditional IRA. Money goes in pre-tax. Tax deduction on contributions, just like a traditional IRA. Money goes in pre-tax. It's the only account that gives you tax benefits on the way in while the money grows and on the way out. Triple tax advantage. Triple. No other account does this. For 2025, you can contribute up to $4,300 to an HSA if you have individual coverage, or up to $8,550 for family coverage. The catch is that you need to have a high deductible health plan to be eligible, which isn't right for everyone. But if you're young, healthy, and don't have significant medical expenses, an HSA can be one of the most powerful retirement accounts available. The HSA Power Strategy. Here's the strategy that makes HSAs incredibly powerful. Pay for your current medical expenses out of pocket if you can afford to. Don't use the HSA money. Let your HSA money stay invested in the market. Let it grow for decades. Keep all your medical receipts. There's no time limit on when you can reimburse yourself for qualified expenses. You could pay for a doctor visit today, keep the receipt, and reimburse yourself from your HSA 20 years from now, tax-free. After age 65, you can withdraw money for any purpose. Non-medical withdrawals are taxed like a traditional IRA, but medical withdrawals remain tax-free forever. Medical expenses in retirement are essentially guaranteed. The average couple retiring today will spend over $300,000 on healthcare throughout retirement. So having a pile of tax-free money specifically for healthcare costs is like having a secret weapon against one of retirement's biggest financial risks. The math on HSAs can be absolutely stunning. If you max out HSA contributions for 30 years and achieve a 7% annual return, you could have over $400,000 in completely tax-free money available for medical expenses. That's not just a safety net, that's a fortress. Once you've maximized your HSA contributions, you go back and max out your 401k contributions beyond the employer match. For 2025, the contribution limit is $23,500 for most people, or $31,000 if you're 50 or older. At this point, you're really cooking with gas from a tax perspective. Between your IRA, HSA, and 401k, you could potentially shelter over $35,000 annually from current taxation if you're under 50, or even more if you're eligible for catch-up contributions. That's serious money that gets to compound without the IRS taking their cut every year. Here's something that might surprise you about this whole process. Most people never get past this point. The average American saves about 6% of their income, which usually isn't enough to max out even their employer match and IRA contributions, let alone everything else. But if you're one of those people who can actually work through this entire sequence, congratulations. You're already in the top 5% of savers in America, and you're setting yourself up for a retirement that most people can only dream about. The beautiful thing about following this optimal order is that each step builds on the previous ones, creating a financial foundation that gets stronger over time. Your emergency fund prevents you from derailing your progress when life happens. Eliminating high interest debt stops you from bleeding money to interest payments. Maximizing employer matching gives you guaranteed returns. Tax-advantaged accounts let more of your money compound without government interference. But we're not done yet. Once you've worked through all these tax-advantaged options, that's when we finally get to the step that most people want to start with: taxable investment accounts. Taxable investment accounts are the wild west of investing. This is where you can buy individual stocks, trade options, speculate on cryptocurrency, or just invest in good old index funds without any contribution limits or withdrawal restrictions. It's also where most people make their biggest mistakes, because they think having access to every investment under the sun automatically makes them smarter. Here's the thing about taxable accounts that drives me nuts. People get so excited about the flexibility and unlimited contributions that they completely forget about the tax drag. Every dividend payment gets taxed. Every time you sell an investment for a gain, the IRS wants their cut. It's like running a race while someone keeps throwing sand in your shoes. You can still finish, but it's going to be a lot harder than it needs to be. The tax efficiency of keeping money in retirement accounts versus taxable accounts can be absolutely staggering over time. Let's say you invest $10,000 annually for 30 years. In a tax-advantaged account earning 7%, you end up with about $944,000. In a taxable account with the same return but paying taxes on dividends and capital gains along the way, you might end up with closer to $700,000. That's nearly $250,000 difference just from tax drag. But here's where taxable accounts become valuable once you've maximized everything else. They offer complete flexibility. Need money for a house down payment in 5 years? No problem. Want to retire early before you can access your retirement accounts? Taxable accounts give you the bridge funding you need. Planning to leave money to your kids? Taxable accounts get a step up in basis when you die, which can eliminate capital gains taxes entirely. So yes, taxable accounts come last in the hierarchy, but they're still an essential piece of the puzzle once you've done the foundational work first. Let's put it all together. The complete hamster investment hierarchy. Step 1. Emergency fund, $1,000 to 1 month to 3 months of expenses. Step 2. High interest debt, avalanche or snowball, but kill it. Step 3. Employer match, capture that free money even before finishing debt. Step 4. IRA, max it out. Choose traditional or Roth based on your tax situation. Step 5. HSA, if eligible, max it out. It's the triple tax Swiss Army knife. Step 6. 401k, go back and max it out beyond the match. Step 7. Taxable accounts, the Wild West. Invest in low-cost index funds for flexibility. This isn't complicated. It's just a sequence. But following this sequence is the difference between building wealth on a solid foundation and building it on quicksand. Most people want to skip to the top. They want to pick stocks, trade options, get rich quick. They want to start with step 7 and ignore steps 1 through 6. And then they wonder why they're not getting anywhere. But the people who actually build lasting wealth, they do the boring stuff first. They build the foundation. They kill the debt. They take the free money. They maximize the tax advantages. And then, and only then, they start playing the exciting games. Here's the truth. You can follow the crowd, you can chase the hot stocks, buy the meme coins, and hope you get lucky. That's what most people do. Or you can follow the hierarchy. You can build real, lasting wealth, slowly, boringly, but surely. And 20 years from now, you'll be the one who's financially free while everyone else is still trying to pick the next Tesla. So there you have it, the optimal order for investing your money that most people completely ignore in their rush to get rich quick. Emergency fund, high interest debt, employer match, IRA, HSA, max out that 401k, then and only then taxable accounts. Follow this sequence and you'll be building wealth while everyone else is still trying to pick the next Tesla. You'll sleep better at night. You'll make decisions from a position of strength instead of desperation, and you'll get to retirement with more money than you ever thought possible. The hamster wheel is there for everyone. Most people jump on it and run as fast as they can, going nowhere. But you don't have to. You can build a system. You can follow a hierarchy. You can get off the wheel and build something real. Your future self will thank you for doing the boring stuff first. I promise. If this video helped you see investing in a new way, hit subscribe. Share it with someone who needs to hear it, and remember, the right order changes everything.